Have you ever looked at your insurance policy and felt like you needed a decoder ring to understand it? Well, you're not alone. But today, we're going to crack that code wide open. We're going to pull back the curtain on the core legal ideas that make every single insurance contract tick, so you know exactly what you're getting into. Let's do this.
So here's our game plan. We'll start with the basic promise that's at the heart of it all. Then, we'll get into what you can actually insure and what you can't. We'll cover your absolute duty to be honest, and then talk about a really important 2-year safety net that's built in for you. And we'll wrap it all up with the rules on premiums and the fine print.
All right, first things first, the basic promise. Look, insurance isn't just a document stuffed in a filing cabinet. At its core, it's a pact. It's this fundamental agreement that we've created to handle life's big, scary uncertainties. Understanding that pact is step one to really owning your policy.
So what even is a contract of insurance? It's actually pretty simple. You agree to pay a company a small, regular fee. That's the premium. In return, they take on a huge, specific risk for you. If that risky thing actually happens, they promise to cover your loss. You're basically trading a small, predictable payment for peace of mind against a huge, unpredictable disaster.
You know, every insurance deal, no matter how complicated it seems, boils down to these 3 things. 1, you pay the premium. That's the fuel that makes the engine go. 2, the insurer officially takes on your risk. It's literally transferred from your shoulders to theirs. And 3, they now have a duty to indemnify, which is just a fancy legal way of saying they are obligated to pay up when you have a valid claim.
And here's a really cool legal tidbit. The courts don't care what you call something. If it walks like a duck and quacks like a duck, you get the idea. There was this case with the so-called Protection and Indemnity Club that tried to argue they weren't an insurance company. The court basically said, nope, you're taking money to cover someone's risk. That's insurance, plain and simple. The promise is what matters, not the label.
Okay, so this brings us to a huge question. What can you actually insure? You can't just go out and buy a fire insurance policy on your neighbor's house hoping it burns down. The law says you have to have a real, tangible stake in the thing you're insuring. And that stake has a name, insurable interest.
So what is insurable interest? It just means that you would personally suffer a real loss, financially or otherwise, if something bad happened to that person or that thing. You have to have some skin in the game. It's the key difference that separates insurance from just straight-up gambling.
Now here's where it gets a little tricky. The rule for insurable interest isn't the same for everything. For life insurance, you only need to have that interest on the day you buy the policy. But for property insurance, like for your house or your car, you have to have that interest both when you buy the policy and at the exact moment the loss happens. Think about it. If you sell your car, you can't file a claim if the new owner wrecks it, even if your name is still technically on the policy. Your interest is gone.
So practically speaking, whose life can you insure? Well, the law is pretty clear on this. You've always got an insurable interest in yourself, of course, as well as your spouse and your kids. But you can also insure someone you rely on for financial support, or even someone who owes you a significant amount of money. It all comes back to that potential for a real financial loss.
Okay, I really want you to listen closely to this next part because it is probably the most important responsibility you have as a policyholder. An insurance contract is special. It's held to a higher standard, called a contract of utmost good faith. And that puts a huge burden of honesty squarely on your shoulders.
This brings us to the idea of concealment. The legal definition is pretty specific. It's when you neglect to communicate something you know and should reasonably know is important. Pay attention to that word neglect. It means it can happen even if you weren't actively trying to pull a fast one.
So what's the real difference between hiding something and flat-out lying? Well, concealment is a negative act. You just failed to mention something important. Misrepresentation, on the other hand, is a positive act. You actually said something that was false. And here's the absolute kicker. For concealment, the insurer can void your policy without proving you meant to cheat them. Just the act of holding back a key fact is enough. Let me tell you about this Saturnino case. It's a textbook example. A woman had an operation for cancer. Just 2 months later, she applied for life insurance and didn't mention it. She passed away within a year, and when the insurance company found out about the surgery, they denied the claim. The court agreed with them, saying that by staying silent, she led them to believe the risk was much lower than it actually was.
Now, let's look at the flip side, misrepresentation, with the Florendo case. Here, a man had a serious heart condition and a pacemaker. On his application, he checked the box saying he was in good health. See the difference?
He didn't just stay quiet, he made a statement that was actively false. When he died, the court had no problem voiding the contract. It was a clear-cut case of misrepresentation.
Okay, I know all this talk about concealment and misrepresentation might sound a bit scary. It feels like the insurance company holds all the cards. But they don't. The law builds in a very powerful protection for you, the policyholder. It's called the incontestability clause.
And the magic number you absolutely have to remember here is 2. 2 years. That's the timeline that changes the entire game.
So here's how it works. Once your life insurance policy has been up and running for 2 full years while you're alive, the insurance company loses its right to go back and cancel it because of something you concealed or misrepresented on your application. It's basically a statute of limitations on their ability to challenge your policy.
And why is this so important? Well, it provides a sense of security and finality. It stops an insurer from taking your premium payments for, say, 15 years, and then, when a claim is filed, trying to dig up some tiny error on your old application to get out of paying. It forces them to do their homework up front and protects your family down the road.
All right, let's land this plane by talking about the practical, day-to-day stuff, paying your premiums and understanding the promises you make in that fine print. These are the non-negotiable rules of the game.
The default rule for insurance is incredibly strict. They call it the cash and carry rule, and it means exactly what it sounds like. If you haven't paid the premium, you don't have a valid policy, period. The insurer's promise doesn't kick in until your payment has been made. But come on, this is the real world, right? Things happen. So you might be wondering, are there any exceptions to this incredibly tough rule? And the answer, thankfully, is yes. There are a few key exceptions. Most life insurance policies have a grace period, usually about 30 days, where you can still pay late and be covered. Also, if the policy document itself says the premium has been paid, even if it hasn't, the law says the insurer is stuck with that statement. Agreements to pay in installments can also keep the policy active, as can certain credit arrangements the insurer makes with your broker. So, let's wrap this all up. If you remember nothing else, remember these 3 things. 1. Disclose everything. Honesty isn't just the best policy, it's the only policy. 2. Pay your premiums on time. Your payment is the lifeblood of the contract, but make sure you know your grace period. And 3. Actually read the fine print. The promises you make in there, called warranties, are just as binding as the ones the insurer makes to you. At the end of the day, the law tries to make insurance a fair deal, but it's a two-way street. Now that you know the rules of the road, I want you to ask yourself a serious question. Go pull out your policy and take a look. Is it the ironclad safety net you've always assumed it was, or have you been unintentionally taking a gamble with your future?